Thanks everyone for joining today for this very interesting topic on inflation. Certainly a very timely topic that seems to dominate the news these days. I am Robin Doyle, as Viviana mentioned, a board member for the Center for Women in Business at Rutgers. And I am excited to be doing these financial literacy series with JPMorgan, as I spent 29 years of my career at JPMorgan. So it's particularly fun for me to continue the interaction with the company. Very, very pleased today to introduce Stephanie Roth. Stephanie is a senior markets economist for the Global Wealth Management division of JPMorgan. And there in that area, she focuses on business cycle dynamics as well as the impact of China on the global economy. Prior to that, she was involved in specialized strategies and developing managed portfolios at JPMorgan. And prior to that, she worked for Cornerstone Macro, also as an economist, and Equinox Partners, where she was a statistics consultant. Stephanie graduated from Bucknell University in math and economics, and she has a master's in statistics from Columbia. So certainly her qualifications are excellent for this particular topic. So thank you so much, Stephanie, for joining us today. Anything you want to add to the intro?
No, that sounds great. I'm really happy to be here. And definitely an important topic, not just for markets, but really for our daily lives. So I'm excited to dig in.
Yeah, excellent. That is perfect. So great. So as Viviana mentioned, everyone, by all means, as we're going through the Q&A with Stephanie, put your questions into the chat and I'll try and interweave them into the dialogue as much as I can. And we'll try and make this interactive. So let's start with some real basic stuff, Stephanie. What is inflation? It always sounds bad, but maybe it's good too. So can you talk to us a little bit about that?
Sure. So inflation is the growth rate of prices. So like how much are prices going up or down? Now, inflation might sound like a bad thing, especially because the media today is hyping that up as negative, and we're having too much inflation today. But you also don't want to have too little inflation. So you need the kind of the right amount of inflation. And the Federal Reserve has a target for inflation. So they're the ones that are really in control of trying to manage the inflation for this economy. They target an inflation rate of 2%. So what does that mean in real layman's terms? They're hoping that the growth rate of prices will be growing around 2%. So that means that on average, the things that you buy should be up about 2% versus the prior year. We measure inflation using something called the CPI, or the Consumer Price Index. And that's what they do is they calculate a rate of inflation based on what everybody tends to buy. So they get a basket of goods and they see how much is that basket up versus the prior year. The goal is for that basket to be up about 2% every single year. Now, the Federal Reserve really cares about a basket of goods that excludes food prices and excludes energy prices. And the reason there is because those things are really volatile. They move quite a bit. So in order to get a real sense of the underlying measure of inflation, we look at a measure called core inflation, and that excludes both of those items. Now, the Federal Reserve does look at them. We all do buy gasoline, we buy food, so of course that's important. But the reason they exclude them is in part is because of the volatility that I mentioned, and also because the tools that the Federal Reserve aren't really great at adjusting for food prices. Food prices often are subject to the weather, and the Federal Reserve has nothing to do with the weather. And same with energy prices. A lot of that has to do with geopolitics. And again, the Fed has nothing to do with that. So they tend to target a measure of inflation that's moving about 2%. That's consistent with a healthy economy. If you have inflation that's too high, that's a problem. Certainly, we don't want to be paying a lot more for goods. And as inflation starts to pick up, there's the risk that it just continues to pick up and it kind of spirals. And that becomes very dangerous. And that means that the Fed will have to potentially cause a recession in order to get that down. And to be fair, there's a chance of that today. And the Fed wants to be extra careful of that because the higher inflation gets, the bigger the problem they have. You also don't want to have inflation that's too low. If you have inflation that's 0% or even negative, that's a real problem also, because people then say, well, you know what? If inflation is 0 or negative, I'm just going to wait to do all my purchases because prices are going to be cheaper next year. And that creates a real problem for the economy also. So it's kind of like a Goldilocks thing. You want just the right amount of inflation, and then we're kind of in a good place. Today, inflation is a little bit too high.
So the Fed tries to control inflation and manage it to this 2% level. So how do they come up with this 2% level? Why does that seem to be the right number?
Exactly 2% is, I wouldn't say arbitrary. It's not arbitrary. It has to do with the growth rate of the economy. So the economy is growing at around a 2% rate as well. So the real underlying growth. So they target a level of inflation that's fairly consistent with that. So that's kind of how they land at 2%. Could it be 2.5%? Sure. But they landed that 2% because that's kind of in line with that. And they look for inflation to average 2%. So every single year doesn't have to be exactly 2%. But when we're in a year where inflation is 6%, then you're not really going to get to 2% anytime soon, by just by math. So they need to bring inflation down, and that's kind of how they get to that 2%.
Okay, all right, that makes it interesting. So the management of this, right? You described a little bit about bad and too low of inflation is not good, because then people don't purchase. Too high of inflation, people don't purchase because it might kick you into a recession. Is that really the crux of it? In terms of their managing, they want the economy to just hum along at a nice level rate.
Yeah, that's exactly it. Because if you have the economy out of balance in any direction, you tend to build excesses. So things that just aren't quite right. Like, for example, if anything is out of balance, debt is a big one. Then you end up in a situation where you could have a crisis within the financial system. So the most obvious example would be the housing crisis that we had in 2006, 7, 8. People started to buy too many houses, prices got inflated. That's another sort of area within inflation. So you had house price inflation becoming a real big problem. And that led to the Fed, having to end the cycle. They raised rates. And it didn't turn into just an ordinary recession because we had all of this excess debt, because people, sort of built into this frenzy of the housing boom. It created a real problem, and it made the recession much more deep and significant than it had to be.
And this particular time, the inflation is driven by all sorts of factors. Can you maybe share with the audience a little bit some of the factors that you focus on in terms of driving the inflation that we're experiencing right now?
Yeah, I think there's 3 chapters to the inflation story. So the first chapter relates to the pandemic, and everybody was at home and they were buying all kinds of goods. I certainly know Amazon was coming to my house every day. So all of these goods were showing up at everybody's doorsteps, and a combination of companies had trouble keeping up with that kind of demand. This is not, people were buying much more goods than they were used to buying. So companies weren't really prepared for that. And then on top of that, there were supply chain issues within China. So they were having trouble getting all of the parts that they needed to even make the goods. So on top of people wanting more goods than normal, they had trouble making the goods. You had this supply and demand mismatch where there was a great demand for a certain amount of goods, and we didn't even have enough supply to keep up. So that pushed up goods inflation. The worst area within that would be within vehicles. So used prices surged. Used car prices went up about 40%, which is crazy. So that's probably the area that saw among the biggest inflation, but really all prices of goods went up around the same time. So that was chapter 1. It was related to demand for goods and the supply chain issues, especially since we're linked to China, and there was really big COVID issues and issues with the ports. Chapter 2 of inflation is related to the US domestic economy. The economy was really starting to pick up, especially in 2021. People were feeling good, wages were going up. So they started to not only continue to spend a decent amount on goods, but then they also started to do services. As the economy started to open, they wanted to go to restaurants and plan trips. So they're spending kind of more than they normally do. And it was an economy that was kind of humming along at a pretty robust rate. So we had a pickup in service inflation at the same time. And service inflation tends to be very sticky. When service inflation picks up, it's linked to a stronger economy, which means that it can be even more lasting. And that's what the Federal Reserve started to get concerned about, was because this type of inflation tends to last a while. And two maybe key areas within that, one would be rent inflation. So I don't know if anybody on this call has tried to find a rental apartment anytime recently, but rents have picked up a lot. So that's a big area within the inflation basket. It makes up about a third of the inflation, which is a big number. So we started to see rent inflation pick up. That was a bit of a challenge. And then just general service inflation, things like restaurants, things like dry cleaners, all of that stuff started to see a pickup in prices. So that's chapter 2 of inflation. Chapter 3 relates to the war in Ukraine. As around the February period of time when the news around the war came out, energy prices picked up in a big way. And because Russia is a big producer of energy, Europe is particularly exposed. So that became a big problem because they weren't able to get all of the energy that they needed. And energy is a global thing. So even though we don't really rely on so much Russian energy, it just pushed up the price of energy, broadly speaking. So that became a bit of a risk from the energy price perspective. And then on top of that, we're very vulnerable to food price inflation as it relates to the war in Ukraine. Ukraine is a big producer of grains, big producer of fertilizer. So that just created an additional sort of kicker on the inflation front. So I would say it's a combination of those three things. We're now starting to see the picture look a little bit better, at least on the surface. You might not feel it, but in the underlying data, it's getting a little bit better, but we have definitely a long way to go.
Mm-hmm. So in terms of what you described earlier for us, between the regular, like overall CPI and then core inflation, excluding the energy and the food, that core inflation was still high, and that was driven by some of the services and the demand for those sorts of things.
Yes, exactly. So the conversation around the war in Ukraine doesn't really impact the headline inflation, and headline inflation is the inflation where we include food and energy as well. It doesn't really impact it there, but because we're already facing high inflation, just having a shock on top of that became a really big challenge, certainly for the Federal Reserve as well.
Yeah. Okay. And how about relating to jobs? Like, how does the job market interact? Does the job market play in with this inflation and salaries and all that?
It sure does. So the job market doesn't have much to do with that chapter 1 of inflation where people were buying goods, maybe a little bit because people are starting to get, higher wages so they can buy a little bit more goods. But I would say it's that chapter 2, which is the service inflation, which is really linked to the labor market. So as people start getting wage increases, companies have to try to protect their profits. And in order to do so, they try to raise their prices. So it becomes a little bit of a feedback loop where wages start going up, then companies are having to pay their people more. And because of that, then they have to raise their prices. So they all kind of interact. And I think digging into the root of the problem, at least within the labor market, is the labor market is too strong, which might sound a little counterintuitive. You would think, oh, great, people are employed and they're getting paid a lot. That it sounds like a really good thing, and it is to some extent. But it became too much of a good thing because what happens is if there's not enough people to employ, then companies have to start paying more. So then they offer higher wages in order to attract talent. And then that becomes a problem within this whole conversation of inflation because now they're paying their workers more, they have to raise their prices. And it creates this sort of feedback loop and inflation just continues to get worse. So wage inflation is a good thing, but not if it becomes too high. And that's kind of the environment that we're in.
So that's where this has to be managed down to a level, because I'm sure anybody on the call who's maybe getting ready to graduate and look for a job would be thrilled to know that there is inflation of salaries.
Exactly. So that sounds great, except for the challenges. Now the Fed is faced with a scenario where all of this inflation is too high, and they might need to create a recession in order to solve the inflation problem. So if you're looking for, so kind of that could create a worse problem if you're looking for a job and the labor market is no longer as strong. So it's a bit of a balancing act, and hopefully the Fed doesn't end up causing a recession, but that is a legitimate risk, and that's why inflation high inflation can become really risky for the economy because the Fed has to get it under control. And in doing so, they might have to hurt the economy in order to sort of get it managed closer to that 2%.
Mhm. So we certainly, Stephanie, have all, heard the news about rate hikes and all that kind of thing that the Fed is doing in order to slow down the inflation. Is that the real key tool they have in their toolbox? Is there other things that they do to help to manage the inflation? Talk to us a little bit about the tools the Fed uses in order to manage and get back to the level that seems more appropriate.
So their tools are pretty broad. Number one is rate hikes. That's generally speaking how the Federal Reserve conducts their monetary policy. They raise interest rates, and they raise a rate called the federal funds rate. It's a rate that nobody pays. It's not really, you don't go to a bank and say, I'd like the federal funds rate. But they raise this federal funds rate, which then impacts all kind of rates in the system. So it impacts your mortgage rate, it impacts the rate, the auto loan rate. So when they raise rates, it's a signal for the market to sort of raise rates accordingly. And when that happens, it tends to slow the world down because all of a sudden, as rates increase, the desire to take out a loan and conduct activity becomes a little bit less attractive. So mortgage rates, for example, were a little bit under 3% at the start of the year, and now they're around 7%. That's a massive increase. And now all of a sudden, people who were really interested in looking for homes are now a little bit less engaged in the housing market, and they're saying, you know what, maybe I'll wait. Or there was a home that I really liked, I can't really afford it now. I'm just gonna sort of sit back and be a renter for the time being. So it really tends to drive consumer behavior and slow the world down that way. So by them hiking interest rates, it tends to just be a headwind on financial conditions, or really just tightening of financial conditions in the economy, or really slowing down activity because rates become just a little bit too high. And that's also true in the business sector. Companies, when they want to invest, they often have to take out a loan in order to do so. And if all of a sudden rates are higher, they better expect that their loan is going to pay off. And now some projects that were looking attractive a year ago maybe don't really look attractive anymore, and they're not going to do them.
Right. So
that's their primary tool. There are other things. The other thing is the most important tool after raising interest rates is something called quantitative easing. That's a little bit more complicated, but the idea here is basically they usually only do this during a recession. And what happens is they'll buy bonds. So they'll buy bonds that are out there. And what they're doing is they're hoping to push down interest rates. Because now all of a sudden there's a buyer that's out there that's going to be just buying and buying bonds, and that will make rates go down. So they can either, in a recession, they can lower rates, which is the most effective tool, and that's what they're going to do in any recession, or they can start buying bonds. Chances are they'll probably, at least in the past couple recessions, they might do both. Now we're the opposite of that, and they're raising interest rates, and they're letting bonds roll off. So they're doing basically the opposite of what they did during the COVID recession, because they're hoping to slow down the economy.
So do they also sell bonds?
They could, but they don't necessarily. So the exact opposite of buying bonds in theory would be selling bonds. They don't necessarily have to do that because bonds have a maturity. So let's say it's a 5-year bond.
Yeah.
At 5 years, they can either choose to buy another bond to replace it, or they can just let it roll off the balance sheet. So rather than having to sell it because time is going by and they can just let the bonds roll off, they're just doing that at the moment. There's a chance they'll have to sell bonds in the beginning part of next year, but as of now, they're letting it be a little bit more passive. But it's a similar concept. They just don't happen to be currently selling bonds, but it's a similar sort of impact on the economy.
So, the prospect of a recession, I think, is really uncomfortable for a lot of people, and we have, a question came through in the chat, like, doesn't the recession then cut jobs and, make it really more difficult for people to afford to live, because obviously they've lost a job and they're also still suffering from the higher prices from inflation. And the Fed has been quite aggressive in the hikes of the Fed funds rate, it seems. Can they can't they manage this without getting us into a recession, Stephanie?
So I'll say a couple of things. First, on like the concerns around recession. Recession isn't, it never feels good, but I would highlight the last couple recessions we've experienced have been incredibly extreme ones. So a, a normal recession might not feel so bad, or at least nearly as bad as the COVID recession. Wouldn't feel as bad as the Great Financial Crisis. So the recessions that we have in recent memory are certainly extreme ones. It probably very likely would not look anything like those things. Of course, that makes it more difficult to find a job. It makes it more difficult to get paid higher wages, but it's not kind of as challenging as those recessions. So I would highlight that first. The Fed would love to land the plane. They would love to sort of raise rates to the perfect level and not cause a recession. The problem is it's really hard to do.
Right.
Their ideal goal is, and this is what they're communicating, we're hoping to land the plane, we're hoping to raise rates to the perfect level that slows down the economy and doesn't create a recession. Historically speaking, they haven't done this very many times, so history is not really on their side, which is why many forecasters are expecting them to cause a recession, just because it's really challenging to know exactly the rate that they should raise to that would slow down the economy just the right amount. There's no perfect, the economy is always changing. So there's no perfect history that would tell us, all right, if they raise rates to 4%, that's going to be the exact right level. We don't really know. The economy is always different. They're guessing. They have tons of models. They have hundreds of economists, and they're hoping to do it just right. But they recognize that it's really challenging, especially in an environment where inflation is a problem. It's really not easy. So our base case is that they do cause a recession in the middle part of 2023. We think it'll last, about a year. And we don't think it'll be particularly extreme, but we do think that, odds are not necessarily in their favor.
So it almost seems like we're starting to see it, right? Another question came through talking about the recent layoffs at Facebook/Meta, right? And quite a large number, it seems to be, at that company. Do you think that is, the question really is, do you think it's more tech sector specific, or is it broader? Do you expect to start seeing, some layoffs coming as the Fed continues to do its work to slow down the economy?
Right now, it's very narrow. It's mostly focused in tech, a little bit in the financial space, companies, maybe less so, laying off people, but more just doing hiring pauses. It'll probably broaden out. I think it's likely we'll see broader based layoffs, but right now it's been very much in a silo of technology. But if it turns out that we're going to get a recession, by definition, for the most part, that means that the unemployment rate will tick up, which means, broadly speaking, people are, some people are losing their jobs. That's not everybody by any means, but that does tend to mean that companies do certain rounds of layoffs, and it means it's could be a challenging environment for a period of time, and it's generally by definition a broad-based slowdown in the economy. If it were to stay in just the tech sector, then that would mean maybe the Fed did its job, and maybe the Fed actually got to the exact right interest rate, and it just got limited to the sector that perhaps overhired during the pandemic, and perhaps even overhired over the past 10 years where technology was doing so well. They just need to get rid of some of the additional people that maybe they don't necessarily need anymore. So if it just stays within the technology sector, then that would mean that the Fed maybe accomplished their goal. So I hope it doesn't end that way, but there's a legitimate possibility it becomes broader.
Right. And if it becomes broader, in particular for the students on the call who maybe are, coming up to graduation, it seems like, that could have an impact on the job market for them. And so, obviously, your role is not recruiting, but understanding what's happening may make, it sort of influence the way students go about their job search, perhaps.
Totally. And maybe that's an argument for getting in touch with people early. Right now, the economy is okay. Companies are feeling pretty good. So if there's any opportunity to, get in touch with somebody at a company you're interested in advance, then maybe you can make the connection before things slow down. Maybe that's, there's an opportunity for that, or an opportunity for an internship in the meantime. So maybe there's things to be doing, even at the margin, just in advance. also just keeping an open mind. Maybe if the job market isn't great when you graduate, maybe you take a job that's not your first choice, but it's something that will, help, get you where you want to go. Like, for example, I graduated college in 2010, which is right after the financial crisis. I wanted to go into finance, so good luck to me. So my first job out of college, I worked in a health insurance industry in a statistics job. It wasn't exactly what I wanted to be doing, but I recognized the job market wasn't very good. I didn't see any openings in exactly what I wanted to do. So I found something else, and I did that for a couple of years until the job market improved, and I was able to sort of pivot and do something that I was, really looking forward to.
That's really a great example, Stephanie, and for real life, for you to share, because I think a key point to make to everybody on the call is the recessions don't last forever. I mean, knock wood, the recessions don't last forever. So sometimes you have to sort of, set yourself up so that you can sort of make it through the period and plan for the recovery, right?
Totally. Yeah, and I was in the probably worst. I was following the worst recession that we'd had in recent memory. So, and there still were jobs to be had. It's not most of my colleagues found a job. And that was really one of the worst recessions that we've had in recent history. So, not to scare anybody, but it just means maybe being a little bit more open-minded, or recognizing it might take a little bit longer than you're hoping to find a job, but you'll find one eventually. That doesn't mean companies aren't going to be hiring at all. It just might be a little bit more selective.
Yeah, perfect. Good. Let's continue to talk a little bit about, maybe some other impacts that people should think about as they plan, their for themselves as students and individuals. So let's talk a little bit about how inflation does impact us as individuals. So what are the things that we need to think about in terms of that?
Well, so it certainly impacts your sort of day-to-day purchases. So especially food and energy is what you'll feel the most. Partially because those prices tend to be, especially gasoline prices, they're very visible. You might spend time driving around from gas station to gas station to find the best price. So that's something that might be a little bit more obvious. But there's going to be other prices that maybe you might not notice quite as much. The positive sign is that inflation is moving in the right direction. So this holiday season, you'll probably start seeing more discounting than you have. So you might see better sales than we've seen in a while. So that's a good sign for those holiday shopping. Last year, inventories weren't very good, so companies didn't really have stock. So if you went into, a number of stores, you would see the shelves empty. That's not likely to be the case this time around. Of course, certain goods might be missing, but for the most part, things should look a lot better than it did last season. Other than that, I think keeping an eye on sort of what prices might be elevated. Car prices are absolutely the ones that are the highest. Like I mentioned earlier, used car prices are up about 40% since the pandemic started. So maybe caution around buying vehicles. Prices may come down there. We've already started to see prices come down a little bit, and that may continue. So I think just being an educated consumer, getting a sense of what the prices should be, and thinking about sort of your timing of purchases, especially goods prices, we might continue to see come down a little bit. It kind of depends, but I wouldn't say hold off all your purchases because prices are going to be much lower in the future. It doesn't really work that way either. So, keeping an eye on that is also important. And then when thinking about, I think maybe even the more important thing is about lending in this environment. So when you need to borrow, rates are higher today than they've been in a very long time. So the most obvious would be related to mortgages. Mortgage rates are up pretty significantly, like I mentioned earlier. What we do expect is in a recession, rates tend to come down. So we should expect that rates are going to be lower in the future than they are today. Even if we don't have a recession, we'll likely get a economic slowdown, which usually means rates come down with that also. So we should see rates looking more attractive in the future. So anywhere from, auto loan leases to mortgage rates should be lower then. People tend to, especially when we're forecasting rates, we tend to focus on the 10-year interest rate. It tends to be a benchmark that everybody follows. So that's running right now a little below 4%. Just to give you a sense, we think that will be about 2.5% in about 1 year's time.
That's a pretty big drop.
Yeah, pretty big drop. Rates move a lot. Rates tend to move quickly, and they move, a lot at a time, especially in this environment. Rate volatility is what we call it when it moves around a lot, and it's been very volatile in this environment.
Stephanie, so what are some of the sources that we can look to in order to understand when things are changing? So you mentioned that I think used car prices were up 40% at some point. And at one point, do they start to come down? So like, for example, used car prices, how do we find out to have a peak to see if maybe they are starting to come down? Is that data so lagged that it's not that helpful?
There's a measure called the Manheim Used Car Index, MANHEIM. You can Google that, and you should be able to find a chart. And right now it has started to come down. You want to just see it. It'd be good to see it come down further. So that's the kind of a way to track that.
That's a pretty timely.
Yeah, comes out monthly, pretty timely. The measures in the CPI are also fairly timely. So you can Google, the CPI for used vehicles. There's a database called FRED, FRED. And you can search around there for some of these things. The CPI data, it comes out monthly, and it's on about a 2-week lag. So it's not too bad. So, that's what we're looking at. So, that's as timely as kind of you're going to get on the inflation data. I would say if you're thinking rent inflation, CPI data is very lagged for that. We can get into that. It's a whole complicated calculation, but there's better measures like Zillow or apartment list if you want to get a sense of, how are apartment rents trending.
Yeah. So actually we have a question. You mentioned and talked a little bit about the mortgage rates coming down, being tied to the 10-year and so on, and your expectations for that. Will that translate into rents also coming down, or do you think they're separate things?
Maybe a little bit of both. So they're kind of separate, but kind of related at the same time. So what happened is during the pandemic, house prices went up so much and there was no inventory. People said, okay, I can't buy, I'm just going to rent. So all the people who were potential home buyers went into the rental market, and they took up all the apartments. And this was particularly strong in the middle part of 2021. And then as the housing market has recently gotten hurt because of higher mortgage rates, you're starting to see rent prices come down, and in a pretty material way. So they kind of interact a little bit. So now that house prices are coming down with a lag, rent prices are starting to come down too. We still think that they can both come down further from here. So they'll probably be, a bit more to go. And you can keep following that Zillow or apartment list data to get a sense of nationally how are house prices trending. And then you can also dig in by state and that kind of thing.
Mm-hmm. So the fact that the housing market may increase its inventory potentially and allow people to buy and rates come down will allow maybe there won't be as much demand for the rental apartments is kind of what you're saying, and could impact the rental rate.
Yeah, kind of. Or not even, inventory might not even change that much, but because mortgage rates are up so high, people are less interested in housing. So people are buying less. It's putting downward pressure on prices. And then that's eventually going to put downward pressure on rents also. The whole sector just tends to get hit first with in-house sale for sale, and then in the rental market. Plus the rental market is very sensitive to the economy. So as the economy starts to slow and people's jobs, people hiring starts to slow down, wages start to slow down, the landlords can't really increase the rents quite as much. So they have to be a little bit less aggressive on the rent increases. So then you'll start to see, just as the economy slows down, that rent inflation will cool down too. I think it's important to note though that we shouldn't expect apartment rents to come down a lot. The rate that they're growing will slow. So we might expect them to cool a little bit, or maybe some, for a period of time, landlords weren't offering any incentives. Maybe that kind of thing will come back. but I wouldn't expect everybody to get a notice from their landlord that says, your rent is lower by 10% next year. That probably won't happen, but they might say, we're not going to raise your rent instead.
Yeah. My personal experience with that has been, it's sticky, right? Like it's very sticky. Once it goes up, it doesn't come down like other things. So,
Right.
but I think, from what I've heard talking to people, it's even just finding a place, right, to rent has been a bit of a challenge. So maybe some of that will ease up as well.
Totally.
Yeah. So, yeah. Okay. So great. And we talked a little bit about borrowing. How about credit card debt? Does inflation impact that? Because we talked more about like borrowing for like a bigger purchase, but what about like credit cards and thoughts there?
Yeah, so credit cards, the interest rate that gets charged for credit cards also picks up also in line with interest rates broadly across the economy. That's something I don't know if people tend to pay attention to, is the interest rate on their credit card. So it's worth maybe just looking into that, just so you know, in case you don't pay your credit card down right away. Because those interest rates can be quite high. So that tends to go up in line with interest rates broadly. Similar concept, as interest rates tend to rise on credit cards, people might use them a little bit less and do a little bit less spending, because they're having to pay these higher interest costs. And again, if the economy slows down, interest rates come down, credit cards will be the same thing. The other thing that is worth at least being aware of is during times where banks are worried about the economy, they tend to be a little bit stricter about who they give credit cards to. Right now, they haven't had to do that yet because the economy is still okay and the U.S. consumer is pretty healthy. But if the economy, really weakens from here and banks get nervous, then they'll start being a little stricter about who they give credit cards to. So that's something to just keep in mind. It tends to be a little bit harder, or they're a little bit close. They look a little bit closer at the credit score and that kind of thing.
So from a plan, that's another thing to put on the planning list, just thinking about things like, okay, we potentially going to go into, right now we have inflation. So, let me think about my purchases, my buying, the timing of my purchases. Let me think about, if I have a credit card, I should probably be paying it down. Generally speaking, we advise people to pay them down anyway, because the rates are usually so high. That's like other webinars that we do. So, so that kind of planning. And then as you get into the recession, and thinking that that's coming, thinking about your job search, taking steps early on in order to maybe position yourself better if the job market happens to be a little scarcer. So there are a lot of things really to think about on a regular basis, in particular when we're in these times of like relative volatility, I think, because of the rates.
Yeah. And the other thing we didn't really talk about is this, your savings. If you have savings, keep in mind that rates have gone up, which means if you have a savings account, you're going to get paid a lot more than you used to on your savings. So the rate that is offered in your savings account is actually fairly attractive here. So even if you have some savings, make sure it's not just sitting in your Venmo account that doesn't accrue any sort of interest. Move it to your bank account and get a nice savings account with or a CD that will pay you some interest. Or if you're depending on, and right now the stock market has rallied a lot, so maybe it's a little riskier, but let's say the market falls from here, maybe it's a good opportunity to put a little bit of money into some equities. Start thinking about your investment portfolio, or putting a little bit of money into fixed income. And maybe that's a conversation for another day, but thinking about your the investments as the time comes. Right now the stock market has rallied quite a bit from its low, so we're less excited about the entry point today. But let's say you see a string of a couple of really, really bad days in the stock market. We follow the S&P. The number like 35 to 3,600 on the S&P is a number that we think is kind of attractive. So let's say the market gets down closer to that. Maybe that's a great opportunity to put a little bit of money and watch it and see. Hopefully it goes back up.
I mean, even something as simple as opening a CD, a certificate of deposit at these higher rates, take advantage of the higher payoff for right now.
Totally.
The strategy to have. And someone actually mentioned in the chat that opening a credit card now before the bank maybe tightens up but then also managing that down, right? Like not paying it off, but if you want to establish some credit or can, establish even more credit, get that card now before things become a little bit more restrictive could be a good planning tool. And there was one other, someone was lamenting about the rents in New Jersey in the chat. And I think, we discussed that. It's unfortunate that the demand has driven the prices up so much, and they probably are sticky, and it just makes it very difficult to for people to find that. So, hopefully people can figure out how to balance where they are, and perhaps buying rather than renting turns out to be an option as rates come back down for people. So these are all different strategies to think about as you're planning for, where you live and how you spend your money.
Totally. And depend, I don't know who has time and who doesn't, but if anyone has time for a job on the side, now is a great opportunity because companies are still hiring, especially smaller companies. Especially in the leisure and hospitality space. So if you have any interest in taking on, a little bit more responsibility to get, some money on the side, now is a good opportunity. And store owners are saying that they are having trouble hiring, so they're having to pay up for workers. So now is not a bad time if you happen to be interested in looking for something on the side.
Yeah, makes sense. Everywhere I go, it seems like there's always short staff. So for sure. So look, I think we're at the end of our time, Stephanie. This has been really a great conversation. I'm really hopeful, and it seems like several of the participants are commenting that, there's things that they're really going to think about now in terms of their money and saving and so on. So thank you for your time.